This is where we get into all the aspects of Leeds analysis. Specifically, we're going to delve first in depth into the parts about fundamental analysis. As you understand, there's technical analysis, third level analysis, all this plays parts in the big picture, but let's go granularly, point by point, through some of the first things we look at when we're looking into fundamental analysis. Remember that these concepts are not in order, and some are maybe more important than others, and some are not, and it depends on the actual stock you're looking at as much as anything. So don't think of it like a checklist that you have to hit all of these points, like check, 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 yes, that has this, the company's this, the CEO is that, and therefore that's a good investment. Think of it more like a chemistry, more like an art than a science. So we're going to talk about each of these aspects of Leeds analysis, and then you have to take that sort of direction and put it together into the big chemistry. When you're looking at a stock, you're going to be able to tell all sorts of aspects about a stock, and maybe something that's important for one stock will be not as important for another stock or another type of company in a different industry. And this is sort of what you will learn, and it will become organically, naturally understood over time the more you get into this stuff. One of the first things we look at is the management team. And there's certain things about the management team that you're going to want to find out. You want to understand who's steering the ship, who is the management team, who are the key executives, the CEO, the CFO, the chief operational officer, that sort of thing. And people tend to do what they've always done. So if somebody has run 3 or 4 companies successfully, and now they're running their 5th one, you can be more confident that they'll probably do a good job once again. It doesn't always play out that way, but in general, people who are successful will continue to be successful in terms of increasing the price of the shares of the companies where they work. And at the same time, people who are failures will tend to be failures over time. And maybe they get lucky once in a while, but you should be more concerned with someone who is consistently not successful in terms of bringing the share price of the company higher. So as I said, I like to use free websites. This is yahoo.com, the finance section. You guys have access to this very easily. And it might look a little different on your computer, I have no idea. But you want to be looking at some of the details here, which are all publicly and widely available. So pull up the page for Great Panther Silver. This is in the quote lookup here. You just type in GPL or whatever ticker symbol for whatever company. And if you click on this tab here, Profile, it's going to show you the key executives. Chief Financial Officer, Jim Zadra, is paid $302,000 a year, and he's 50 years old. This is all going to be very important with the research into the management teams of the companies. For example, the chief operating officer is making about $400,000 a year, and the vice president of finance is making about $200,000 a year. And you want to consider, is this about right for this industry? Because a lot of times the compensation is appropriate, even if it's high, depending on how difficult it is to get somebody into the role of this company. And there's very different companies, a lot higher requirements. So for example, if it's a technology company or a biotech company, they might have trouble getting the key people in place, and so therefore they have to pay more to attract the right talent. So one way you can do it is you look at their competition and you look at what kind of pay the executives of the competition are getting. And if it seems that one company is way out of line, then that'll be pretty obvious to you. So don't worry if the number is huge, just worry if it's inappropriately huge, because sometimes there are executives who will be getting paid too much, and that's going to become an issue, or should at least be considered a warning sign. But let's just walk through this one just to show you some of the stuff you can do. Become a little bit of a detective, and look, you find all this information about him, and you can go to his LinkedIn profile and see where he worked previous to what company he's with now. This is what he looks like. This is the company he works with. And before Great Panther Silver, he worked for DDS Wireless for 3 years. You can go and see if DDS Wireless was actually a publicly traded company, and if they were, from the time when he worked there from July 2008 to September 2011, did the price of DDS Wireless increase? If they were publicly traded, how did the company do? It's just a little bit of digital private investigation work. And it can be fun, and you can get into this, and it's a little bit creepy because you're sort of being like a stalker. But it will tell you a lot about what kind of success this guy has had. So DDS Wireless, let's take a look at that. We'll see, can we find this company? Does it exist? And how did it perform in that time? So here's that company. And it looks like they are not publicly traded, and generally what will happen is that at very least there will be links down here about investor relations, and that's generally you can know whether or not they're publicly traded. You can also look into their expertise. Are they appropriate for this type of company? If it's a technology company, if it's a mining company, have they worked previously at other businesses that were in the same industry, and therefore they had the time to build up all the contacts and alliances? Another thing you're going to want to check is, do they have any skin in the game? Do they own some of this company? Are they bound to its success? Because a lot of times a CEO, for example, can just be paid money, the end, and there's no real incentive for them to really make the stock price increase. So just give you another example of what we're looking at. We're trying to get an idea of how much the CEOs and executives are invested in the company's future in terms of the stock price, based on the fact that they would own a certain amount of shares. Let's take a look at another stock, Real Networks. So you type it into the quote lookup, and this will look the same depending whether you're using yahoo.com, Yahoo Finance, or thestreet.com, or MarketWatch, or your broker, your own platform. It's always going to look different. But this is where you go to this section on statistics for whatever company you're looking at. And when you scroll down, you're going to see all the relevant information. And the one you want to look at is the percentage of shares held by insiders. And this is 47%. That's generally way higher than we like, and I'll tell you why in a second. But you can also look at the percent held by institutions. Institutional investors are generally multi-billion-dollar investors, hedge funds, mutual funds, professionals who are buying the stock. So over half of the company is owned by institutional investors. And at this point, I mean, these numbers change over time, obviously, but they generally stay about the same from 1 week, 1 month to the next. But if you look at how much is held by insiders, if this is a high number, such as over 51%, that means that the insiders have complete control over the entire company, the decisions, who gets hired as the CEO next, or who the vice presidents are, how much compensation they get. So you want to see something a little more healthy. And the thing is, too, that when there is a vote on who the new CEO will be, or how much money they are going to be being paid, not everybody shows up and votes. So maybe only 60% or 70% or maybe even 80% of the shares are voted for how much the CEO can make. So even with 47% of the company, that is close enough to complete and total control over every decision of the company. And you better hope that if you're investing in a company like this, that the insiders are trying to increase the share price and do what's in the best interest of shareholders. But ideally, you're going to want to see 10 to 20% of insider ownership, because that shows that they have a lot of skin in the game. If the shares go up, they make money. If the shares go down, they're losing money. And it's not so much that they have an outsized amount of control over the decisions of the company. And one of the favorite things that I like to talk about when trying to find a good company which will increase in value is to pay attention to the barriers to entry. Barriers to entry are a good thing if the company's already established. For example, if you're running a lemonade stand, the barriers to entry are very minimal. You basically need a table maybe and a pitcher full of lemonade and people walking by. Anybody can run a company such as a lemonade stand, or if you want to sell t-shirts, it's so easy to get into that. But what if you are a nuclear technician or a brain surgeon, or you'd use robotics to do really invasive and specific surgeries? The barriers to entry to get to that point and be operating in that industry are astronomical. You need the right, really qualified people. You have to be able to pay them enough. There's all sorts of FDA clearances and approvals and regulatory bodies who are looking over your shoulder. You can't just start that business. So the higher the barriers to entry, the more difficult it is for new competition to emerge in an industry, and also for the companies operating the space to be able to meet all the regulations and put all the dots on the I's and cross the T's. What you would like to do is have a company which is established in a space already, operating there, has jumped through all the hoops they need to, that the industry has a very high level of barriers to entry, because that means that there won't be a lot of new competition suddenly springing up. Don't run a lemonade stand and assume that you won't have competition. But if you are a really high-end computer programmer who's made an algorithm to pull certain concepts out of different programs to put them together into something powerful that you can sell for a lot of money, then yeah, the barriers to entry are pretty significant there. And barriers to entry involves a lot of things, including what the regulations are in the area you're trying to operate in terms of taxation and bureaucracy and everything like that. And also if you're operating in a certain country or area where there's plenty of employees, then that means that there's a good workforce. The barriers to entry for a company going into that space to get enough employees will be lower than if they were in a place where there is a real dearth in the number of really high quality employees that you need to get. And if there's a lot of problems with getting the number of employees you're going to want to need or to have to make the company run, then that means that those are a risk or a concern or barrier to entry in terms of the employee pool. But if you find a company that operates already in a space without a lot of competition, and that space has significant barriers to entry to emerge and operate in that space for new competition, look at it as a really good thing. It's basically like really solidifying the company's position because they're already operating in that space. And we have to get into financial ratios. These are absolutely imperative. And as I said before, this is probably the only part or the most complicated part of the course, but it's easier than you think. And it's going to be the type of thing where when you learn it, all of a sudden you're going to look pretty smart because you understand this stuff that you realize it's not that complicated at all, but that other people will be looking at you being pretty impressed by. And we're going to get into all of the financial ratio information you need to know, but we're not going to do it right now. This has to be in its own segment because it's a really involved topic, I will say. So we'll get into that a little bit later in the course, and we're going to use it a lot. You're going to really like financial ratios. But before you get to the point where you're talking about financial ratios, first, the company needs to come up with what would be the raw numbers of the results of their operations. For example, company ABC made $1 million last year. That's the number. That's the raw number. They made $1 million. Is that a good amount? You have no idea because it's not in perspective. It's better than $500,000. It's less than $2 million. How much should they be making for their industry or their type of business, and how does it compare to the competition? Look at everything in terms of how you know whether or not that number is actually good. Don't think that $1 million profit is good. That's not a good amount of profit for a company that made $400 million the year before. So you have to put the numbers in perspective, and that is your mission as someone who's an analyst, or you're looking into what stocks will do better and which will not do as well. Consider what the company's doing, but also what are the expectations, not just for the company, but also for the potential investors in the company. Most companies will say that we expect to make more money next year, and here's how we're going to do that. So don't take that too much to heart, so to speak. Take it in terms of the context that their job, a lot of times the CEO or the CFO, they need to make it look like they're hopeful or have great expectations in the future that they're going to grow this company. Now, the company may or may not grow. And generally when the CEO comes out in a press release and says, yes, we're going to grow by so much next year, generally they mean it and generally they believe it. So they're not trying to trick you, but just understand that it is in their best interest to put out a press release. Even a company, I could tell you a year from now, they're going to do a press release when the financials come out and the CEO is going to say that they're going to grow in this way and this is the obstacles they overcame. They're going to do all that. I'm telling you ahead of time, that's what you would be dealing with. But just understand that you want to look at the raw numbers first and then try to put them into perspective, and that's your mission as an analyst. The financial reports break down into three categories. So there's the income statement. Think of that about how much money is coming in, what it's costing to produce that income. Then there's the balance sheet. Make that in your mind like a snapshot of how much the company owns and how much it owes. And finally, there's a cash flow statement. This is movement of money coming and going for different reasons, not just money that they make through the income statement where they made $1 million one year and that's $1 million coming in for cash flow. Don't think of it that way. Cash flow can be issuing new shares, it can be loans, it can be investment activities. So there will always be shifts in cash flow that may or may not relate directly to the operations of the company. But a company may make a lot of money, but at the same time, maybe they also issued a bunch of shares which brought in another $1 million. So maybe they made $1 million and they brought in another $1 million. So it's $2 million change in cash flow, even though they've only made $1 million in terms of the results of their operations. And we're also going to pull this part out of this section of the course and we're going to do it separately. We have to address this directly and specifically because I want to show you exact things to look for on the income statement, on the balance sheet, and also on the cash flow statement. And we will get into all of this a little bit later. And I'm just giving you right now the summary of a company. Generally, if they're traded on a regulated stock exchange, they need to report to the shareholders. There has to be shareholder visibility that they're going to tell you every quarterly period, this is how much money we made, this is what it cost us to make that. The result of that is here's how much we now own, and this is how much we owe. And also, we had some things happen with cash flow that changed these numbers a little bit, and we're going to tell you all about this. And we're going to do it every 3 months. An important part when looking into any company is to understand their competitive strengths and weaknesses. This could involve lots of things such as potential workforce, industry regulations, the knowledge base of the people in the area where the company runs, or even the logistical networks, talking about technology logistics, talking about the development networks. So for example, if you're running and operating a gold mine in another country, you want to make sure they have enough workforce, people who are skilled enough to do the jobs that need to be done to have this company develop in the way it needs to be developed. There's also a lot of regulation. Maybe that country where they're operating in, there's a lot of potentially bribery implications. Maybe there's a lot of regulation where you have to fill out a lot of paperwork and make sure that you're doing the environmental things properly and the financial reporting things properly for that specific country. And as the knowledge base of the potential employees, they're going to be good enough to help you develop your mine. There's also going to be logistics such as the logistical network. Is there roads? Is there access to water? Is there enough machinery there? This type of thing. And a lot of times if a company has to buy a lot of machinery, say for mining, to keep with our example, if they're buying it in a country where things are cheaper, then that's representative of a decreased cost. But then take it from a different type of company's perspective. Say you are a development company, you are a bunch of computer programmers, and you're operating out of the Seattle area. You probably have enough skilled workforce who know what they're talking about, what they're doing, and there's probably a pretty good knowledge base among the potential people working there to understand, and they can talk to other people they know because everyone there knows about the same kind of concept. There's a reason why all the major publishers are all based out of Hoboken and around that area, because they conglomerate. You don't want a literary agent who works from Idaho. You want a literary agent who's on the streets in Manhattan among all the other literary agents. These are some of the competitive strengths and weaknesses that the area where they're located, what the potential workforce is, will it be able to be high-end enough to satisfy the needs for this specific company? And I know that we're going really generally and basic with a lot of stuff, but this again is just the introduction to getting more granular, but also it's really difficult to talk about a concept and talk about a specific company other than using it as an example to try and make the point. I could go into International Business Machines, IBM, and look at their workforce regulation and knowledge base, all their financial ratios. I can do that, but it doesn't really help you as much for me to say that, yes, IBM is growing by such and such % per year and therefore yada, 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 because every company is so specifically different. It's very important at this point that you learn the overall umbrella of concepts about how to look into a stock, and then you're going to be looking at it from a customized view as you get more granular into specific stocks, and each one's story will be different than another one. So it doesn't really help for me to get too detailed here because that would be overwhelming, even though it wouldn't be useful. So that's why you need to be okay with the fact that right now we're just going into this stuff generally, and we'll just keep rolling, okay? Now, one thing you're looking at is the influence of the shares. There's so many shares of a company. When a stock has 10 million shares available, each share is worth or lays claim to about 1/10,000,000th of that company. Now, companies can raise more money by diluting the stock, basically putting more shares into the open market. So if a company is trading at $8 a share and they say we need to raise a few $1,000,000, they can put out a whole bunch of brand new shares and issue it into the marketplace and sell them for money. And people buy the shares. The company gets all that money, and now there's way more shares out there. So it went from 8 million shares to 9 million shares. So everybody has a smaller slice of that company by owning one share. But it's a smaller slice of a company which now has another $1 million or whatever because they raised that money by issuing the shares. Generally, when a company issues more shares, they'll raise money, but it will actually hurt the price of the shares that are already on the market. So if a company's $8, they go, we're going to issue another 10% of our total shares. That $8 stock might drop to $7, even $6.50. And sometimes that is temporary. Usually it is, especially if the company takes the money that they raised and they use it efficiently. So not just to buy fancy cars and pay employees too much, but to pay down debts or to invest in new research and development and technologies and new infrastructure or a factory. So the long-term picture is that generally when a company issues more shares, it will typically be done in an effort to the best of their ability to help the company's stock price in the long term. But the announcement can often shock the markets at first. And a lot of times, a company needs to raise a lot of money, and they don't go person to person. They're going to an institutional investor. So they have somebody who says, okay, I will buy $4 million worth of your stock. But they're not going to do it at the market price. They could just buy the stock at the market price if they want to do. They'll say, your stock's trading at $8. We're going to give you however many millions of dollars you need, but we want those stocks given to us at $7 each. So they get all these stocks at $7 and they invest the money. So they actually made a big investment in the company, but they paid a little bit less than most other people who are owning the shares at $8 because the share is going to then also probably decrease towards $7 with the announcement. And then people who had $8 shares are now down a little bit. But as I said, the company now at least has all that money to use. So then your job as an investor is to get an idea of, are they going to be using that money properly and appropriately? And you have to gauge if the money that came in is going to help turn into more money, or if it's just going to be wasted and we're just diluting the shareholders down and down and down. You're also going to see a lot of things such as consolidations of the shares, where it's sort of like a reverse share split, where shares split when you'll get 2 shares for every 1 share you had. So maybe you owned Microsoft back in the day and you had 1,000 shares, then it became 2,000 shares. And then split again and it became 6,000 shares. And so your 1 share or your 1,000 shares of Microsoft eventually became 6,000 shares of Microsoft. Companies that are really growing rapidly, you're going to see share splits all the time. That's why it's such a good indicator for the stock's price potentially going higher. But in the world of penny stocks, you're going to run into share consolidations, also called reverse splits, a lot more frequently. If a stock's price is dropping, a lot of times they will do a reverse split, which involves for every 1,000 shares you had, now you have 100, for example. So that's a 1-for-10 consolidation. Theoretically, the price of the shares should increase by about 10 times in that scenario, but they typically don't react quite that efficiently. It might be a 1-for-10 reverse split, and the share price only go up by a factor of 8 or 7 or 9, but it won't necessarily go up by a factor of 10. In the short term, at least. A lot of times, over time, if the company is still moving in the right direction, the shares will recover, people will forget about the consolidation, and the stock will just be in a more healthier situation. Consolidations happen because a lot of times a company's stock price is too low to be listed on a certain exchange. So if you're trading beneath a certain level on the NASDAQ, for example, for a certain amount of time, they may say either get your share price higher or you're getting booted off the exchange and you're going to have to go and trade on a different exchange. So a lot of times you'll see a penny stock with a decreasing price consolidate their shares so that the average price is no longer 25 cents, but it's $2.50. Or they can do it by a factor of whatever they want. It could be 1 for 20, or it could be 1 for 5, 1 for 3 shares. And they consolidate in whatever degree they decide is best for their situation. And since penny stocks are much smaller companies, and generally they're a tiny company with a great technology or a good workforce or a good patent or something like that, they become a takeover target for a bigger company. A lot of times, recently, it is actually being less expensive for a big gold mining company to take over other operating gold miners than it was to develop their own new finds and that sort of thing. They didn't need to be looking for the gold. It was cheaper to buy a company that's already found it and is running it, and they come along with their economies of scale and their team and their technologies, and they'll take over and really turn that struggling gold mine into a very profitable gold mine. And they didn't even have to explore for the gold, they just bought another company. So when a company takes over another company, and this happens with all industry groups, not just gold mining, but technology and medical stuff, a lot of times a company takes over another company just to get their patents or just to get their workforce, because it's sometimes easier to absorb somebody else's company that has all the right people in the right places and then add that technology to your repertoire. So a company says, well, we used to work on this, that, and the other thing medically, but now we've bought this company and they are the experts in cardiovascular surgeries. And so now that's another thing that our overall umbrella medical technology company can do, because we brought in this new company and they became a part of us. Generally what happens is when one company, we'll call it company A, wants to grow, they can do that by buying company B. And what happens is that the share price of company A's stock will decrease because there's risks and uncertainties in the cost to buy the company, and they have to absorb that all into their business model, and you don't know whether or not it's going to work or not. So there's that insecurity, which will often bring the share price down temporarily when they buy another company. Company B being bought generally will see their share price increase a lot of the times, because not all the shareholders of that company want to sell to the bigger company. So company A says, we will give you more for your shares than the stock is trading at on the market right now. So your shares are trading at $1, but we are willing to pay $1.40 per share for you guys to sell your shares to us, so that we'll get enough of a percentage to be able to force the remaining shareholders to sell, and then we take over company B. So you want your company to be bought out or attempted to be bought out by a bigger company, because it generally is instantly positive for the price of the shares. The caveat to this, and this is one of my biggest concerns with a lot of the companies I really like, is you take the time and you invest in a company when they're still so small and nobody knows about them. Then as they start making a footprint in the world, in the industry, other companies notice them, and sometimes they'll swoop in and try and buy that smaller company. And they'll pay 40% more, maybe 90% more for the shares to make sure they get them, to be able to take them over and absorb them into the fold of their own bigger company. But maybe that little company you bought, you expect that if they keep doing what they're doing and they keep operating the way they're operating, the share price is going to go up 10 times in value. And this bigger company is swept in and picked up a great company, a great investment for a 40% increase in the price, or 60% more than it was trading at. They're getting a deal, and you are losing all the benefit of that smaller company really becoming something bigger. The 10 times of an increase in the share price, not the 1 or 2 times of an increase. That's why you'll see a lot of smaller companies will have a poison pill, and they're going to call it a shareholder rights plan because that's more pleasant, I guess. But it's a poison pill where if another company tries to take over the company in question, there's all sorts of things that happen with the shareholder base almost defensively and contractually, where, for example, one of the companies I owned, and I talked to them about this, I said, because I love the company, I love the technology, but you guys are going to get bought out here, and that's going to basically, take all the potential future gain out of my pocket and then be absorbed into this big multi-billion-dollar company. You'll never even see anything matter in any way whether the company or their technology specifically does well or not. But back to the example of when and if there was an acquisition attempt, there would be a whole bunch of shares, additionally, extra shares, instantly issued to the shareholders, so that if I have 1 million shares and someone tries to take over the company, I all of a sudden have 1.5 million. And so therefore, not only are they paying more per share, they're buying more shares. And this makes it less likely that a company will see it economically feasible to just swoop up and take over a great company. And I told you about investing in what you know, and this is specifically true, especially if you're already reading the industry publications for the underlying industry. If you are really knowledgeable about the restaurant industry and you're reading restaurant industry publications, you're going to know a lot more about the way things work with these types of businesses. This also applies to biotech, it also applies to gold mining, it applies to oil production. Any industry is going to have clouds in the future and sunshine. Some things will be going the right way, some will go the wrong ways. So if you are involved in the fur coat industry you must see that that industry is dying as social shifts happen. Less people are wearing fur coats, and it's actually a negative to wear a fur coat. If you see this shift coming, then you're going to know to get out of that industry. But then if you're looking at autonomous cars and you see this industry ballooning, then yeah, you want to be involved with this industry because the industry itself will be increasing in price potentially. Of course, too, you have to consider that with any growing industry, you're going to see a growth in competition. The more money there is to be made, the more people are going to go there and compete for that money. Some other industry sunshine you might see is if there's technological advancements, where then it makes new businesses possible that did not used to exist at all. So if technology is going the right way, if social shifts are going the right way, if political changes are going the right way, there will be all these shifts and these changes in regulations and social acceptance, such as with marijuana we've been seeing lately. This is all what you need to keep an eye on to understand the industry that the company you're interested in is operating. So you're not just looking at how much money the CEO makes, and you're not just looking at that this company made $1 million last year. You're also looking at what industry are they operating in, and what is the potential market of that industry? How much of that market do they own in terms of market share? And what trends are happening with the industry going forward? What do you expect? That will give you a lot more clarity about how to look at this company and what decisions to make as you're buying or selling it.